Hello, dear turkey enthusiasts. Welcome to Real Turkey channel. We're going to present another very cheerful video today. It's called Turkish Economy Won't Survive the Winter. And I'm doing this in the summer to show that I have great predictive power, sort of like Nostradamus. But before we get into the fray, my apologies for not posting a video for the last month simply because we were on vacation. First, there was a 9 day Eid vacation, the Eid of Hajj, the biggest holiday in the Muslim religion. And then I and my wife had our own annual vacation for about 2 weeks. But I promise that there will be more videos from now on, probably more or two per week. Okay, Turkish economy is having a great tourism season. It will probably generate over $30 billion of revenues or more than 4% of GDP in the short span of 5 months. We should rejoice. Yes? No. Because amidst the summer lull, there are a lot of problems popping up in the economy, and they're very likely to get worse in winter months. In fact, I point to five different and very significant shocks that will hit the economy in the winter, and we will have a crisis. A crisis of what, you might say? Well, you'll have to wait until the end of the video because crises in countries like Turkey, emerging markets, come in different shapes and forms. Let's start our story from Tuesday, actually, Tuesday, 3rd of August, when Turkstat announced July CPI inflation at 80%. Let's take a look at this. This chart is in Turkish, but the red line is the CPI and the blue line is the PPI. 80% annualized inflation, ladies and gentlemen, which puts us right up there at the top of the inflation league with Argentina. I'm sure there are a couple of small countries which are doing worse, but for a country that has an annual GDP of $725 billion, 80% inflation is unheard of. On top of that, the next day, the Ministry of Trade announced July trade deficit. It came in at $10 billion plus some small change, $10 billion per month. Now, this chart is actually from June because July data has not been announced in detail, but it gives you an indication of how rapidly Turkey's trade deficits are rising. In June 2021, Turkey's monthly trade deficit was something like $2.8 billion. In 2022, it soared to $8.1 billion. For the full year, the trade deficit rose from $21.1 billion to $54.4 billion. Obviously, these are massive problems. It's worth noting that summer is the best season for disinflation in Turkey because of traditionally cheaper food prices and a stronger currency motivated by tourism revenues. None of this is happening this year. So, inflation is going to be a big problem over the winter ones. Similarly, while trade deficits don't, are not correlated with the tourism revenues, these size of trade deficits cannot be counterbalanced with tourism revenues. In a good summer, Turkey generates about $7 billion per month of external tourism revenue. But as I've said, look, June trade deficit is $8 billion. In July, it rose to $10 billion. So even over the summer, Turkey is going to be generating monthly current account deficits. And it's more or less the consensus estimate that over the next 12 months, that's from July to July 2023, the current account deficit will range anywhere between $40 billion to $50 billion. Obviously, if you expect a crash in oil and natural gas prices, which I don't expect, then that sum would be significantly lower. Assuming that energy prices will not help Turkey much, they may go down 10%, they may go up 10%, but the trade deficit is so huge, either way, it doesn't make a difference. Turkey is already starting the winter with two major problems: A, rampant inflation; B, a trade deficit, or as the economists call it, a current account deficit, which is becoming difficult to finance. But this is not all. We have more problems for you that I would like to discuss with you. Now, once again, start with the external deficit and look at the dynamics of how it's going to be financed. Remember, I just said from July this year to July next year, Turkey will have a current account deficit of roughly $40 billion to $50 billion. Take the lower figure, $40 billion. But that's not the only financing requirement. Turkey's foreign debt to be repaid in the next 12 months is roughly $185 billion. Let me show you in Turkish a foreign debt amortization schedule for the last 4 months of the year. This is from my good friend and colleague, Mr. Haluk Burumcakci. It says Turkey's foreign debt payment program, and here this is July. The first column is July 2022, and then it goes on all the way to May of 2023. As you see, there is a hump between uh, September 2022 and January 2023, with monthly payments something like 6 to 7 billion dollars per month. Now, usually, what Turkey does is not pay off its foreign debt. Not many countries do. Instead, banks and non financial companies pay off their debt and borrow a similar amount. And if they have plans to issue more loans or to expand their business, even borrow more than they have paid off. Now, obviously, this is not going to be the case in Turkey. There are two reasons for that. First, in its hurry to find foreign exchange to keep the currency stable, the Turkish government has essentially confiscated or frozen all corporate FX deposits in the system. This is sort of like veiled capital controls. And in the winter, it will probably also freeze the deposits of individuals to make ends meet at the external front. This is the first reason. The central bank doesn't have enough foreign currency reserves to defend the Turkish lira, which is slipping as we speak. So what it does, it essentially reaches out to deposits in the banking system and uses them or freezes them to make sure the lira doesn't depreciate any further. The second reason is the external environment, about which I should spend a few minutes, because if you follow economics or global finance, you would read a lot of commentary how a stronger dollar, rising energy and food prices, and of course, rising American bond yields are putting a massive squeeze on emerging nations like Turkey. Oh, I forgot to add that China is already in recession. It's a growth recession. Obviously, China will never have a recession. But China is not only the number one exporter in the world, it's also the number one importer. And it imports largely from other emerging markets countries. So when China doesn't grow, the entire emerging markets world catches a cold. And that's the situation. Already, the conditions in the emerging markets world is extremely fragile. There's a lot of attention about weak countries, and Turkey is one of them. I have just showed you Turkey's foreign debt payment schedule. I can add that a financial instrument which measures a country's creditworthiness, the CDS premiums, are about 900 basis points, which is very close to default. To say the best, Turkey's banks, the sovereign, and non financial companies have a deep, stinking junk rating, which makes finding foreign financing very difficult and expensive. But it's not only that, there is a general uneasiness about a generalized emerging market debt crisis, which makes investors very unwilling to sink new money into emerging nations, whether in terms of real investments, such as buying factories, or in terms of financial investments, such as buying bonds and stocks. In fact, according to International Institute of Finance, only in July, roughly $9 billion of financial capital has left emerging markets since the beginning of the year. That has reached roughly $50 billion. So roughly 25% of emerging markets debt is trading at a distressed level. This is July. What's going to happen in the winter? Well, we know that Fed is going to raise interest rates further. When Fed raises interest rates further, the entire world has to raise interest rates. Turkey doesn't. That's a problem. It weakens the currency. Two, once again, let's look at the foreign debt repayment schedule. Roughly 75% of this debt will have to be re-borrowed. At what rates? At rates which are increasing every month in dollar terms, because Fed is raising interest rates. If you want to borrow in euros, European Central Bank too is raising interest rates. So each month, borrowing from abroad is going to be more expensive for Turkey, and it's going to discourage more borrowers from rolling over their loans or outstanding bonds. They'll simply find cash and pay off their outstanding external liabilities. And finally, dollar strength, which causes domestic investors to buy dollars as savings rather than Turkish lira. And it also adds to the financing costs of Turkish companies. Now, remember, a Turkish company generates most of its revenue in Turkish lira terms, and it has external loans, so it pays these in dollars or euros. When dollar appreciates, then it takes more of a turnover or sales to meet your financing requirements. This is why the external environment is severely to the disadvantage of countries like Turkey. And in the winter, it's going to get worse. I don't think Fed has any intention to stop. And it's quite possible that after Sri Lanka, other countries such as Pakistan or even Egypt or El Salvador may default, which would create a feeling of global panic, which may reverberate in Turkey as well. So you have a situation where you have to finance a huge foreign debt. Your central bank has very little reserves, probably only $30 billion, and it's becoming increasingly difficult to borrow from abroad to finance that trade deficit. So what do you have? You could have a balance of payments crisis. Turkey will not get there. Our politicians are not too smart. They are dumber than the average. The entire world political class is not too smart, but that's a different video. But they will have to impose capital controls or foreign currency restrictions. That's the first problem. That's the first and the second problem. Trade deficits that are difficult to finance and an external environment that's making it even more difficult for Turkey to borrow from abroad and meet its foreign liability requirements. Three, inflation. We have inflation of 80%, but the policy rate is 14%. Now, what does Fed do? Fed is running behind inflation, so it's rapidly raising interest rates, which depresses inflation. In Turkey, that theory is not subscribed to. Mr. Erdogan firmly believes that interest rates have nothing to do with inflation. So Turkey will not raise interest rates, which is the most effective weapon to subdue inflation. So you don't use monetary policy. You can't use fiscal policy. That is, another way to lower inflation is to cut government spending. Why can't Erdogan do that? Simply because within the next 11 months, we're going to have presidential and general elections. It would be political suicide to go to belt tightening mode. Instead, fiscal expenditures will be increased, which will add to the fires of inflation. The currency is weak, and since Turkey imports roughly $300 billion worth of goods and services for an economy, for a GDP that's $725 billion, of course, when the lira depreciates, the lira value of imports increase, and that's reflected to inflation. But there's another reason, and that's what Fed is extremely afraid of, which is entrenched inflationary expectations, or in technical term, inflation expectations being unmoored, disanchored. That has already happened in Turkey. Inflation has a life of its own. Unless you fight it, and fight it very hard to death, it has a tendency, by inertia, to go up by itself. And how does that happen? Well, the workers demand higher salaries or wages simply because inflation eats up their disposable income. Pensioners, state workers demand the same, and every private sector company that has a demand raises its price according to expected inflation, which is going up higher each month. And finally, as I've said, Turkey is going to have double elections in the next 11, 12 months, either in May or June of 2023, before which it's customary to raise the minimum wage, to pay handsome salary and wage increases to civil servants, and to reward the pensioners for voting for the government. So you bring all of these factors together, and Turkey is facing triple digit inflation. Not convinced? You're not convinced? Let me show you another graph, which I showed, but I'll show it again. Look at this chart. The red line is the CPI. The blue line is the PPI. That's the producer prices. Now, which one? Well, as you see from the lower segments of this chart, they usually move in tandem. Not 100% correlation, but relatively highly correlated. Now, look at this spread. And which way do you think it will close? Well, the answer is very simple for economists. If you have a recession which reduces domestic demand, then of course producers can't sell and they lower their prices. So PPI declines towards the level of CPI. But we can't have a recession simply because no government has ever won an election in a recession. So Mr. Erdogan will roll out the pork barrel to keep economic growth continuing, which means there is going to be sufficient demand for producers to raise their prices. In a nutshell, it is more likely than not that this red line approaches the blue line than the other way around. So, recap, we have a current account deficit problem, which is becoming borderline non-financeable. We have an inflation that's bordering on three digits, three-digit inflation. Now remember, not that I'm an expert in American politics, but I understand Biden's poll ratings are something like 33, 35%, and in generic congressional polls, Democrats are pulling 5 percentage points below Republicans. I'm not going to say inflation is the only reason, but you be the judge. I think inflation is a big reason why Biden and Democrats are so unpopular. It's the same story in Turkey. If you have high inflation, people don't like the government. So let's look at the third problem, which is happening all across the world, and all the governments are showing willful neglect, which is COVID-19. We have a monster wave. The official count is roughly 40,000 cases a day, but health experts, and I read this stuff religiously since I'm 62 years old, and if I catch COVID, I'll probably not survive because I also smoke 2 packs of cigarettes. I won't show you a cigarette. You too probably won't like that. The actual cases are not 40,000 per day, but 4 to 10 times higher than that. So we could have 160,000 cases a day or 400 cases a day, which is way higher than the past week, a past peak in the last winter. Why the willful neglect? Well, I think world governments have decided that it's extremely politically unpleasant to bring back curfews and social contact mandates simply because people hate them. And Omicron is not deadly. So, a few people will die, but it's better than losing elections or facing a riot. So, we'll shoot for herd immunity. This is what Turkey does, but there's another reason for it. Turkey knows that if it acknowledges her COVID 19 wave, it will not get any tourists. And a lot of domestic tourists will stay at home, particularly people like, Attila Yeşiladov, who are 62 years old. And that's going to put a damper on the economy. But, uh, these Omicron waves are not going to fade out by themselves, unlike the previous ones, simply because people can catch Omicron, fall sick, recover, and then fall sick again. There is not that much of a take up for new medicines, for new vaccines in Turkey. Nobody wants to get jabbed 4 times a year. So this problem is going to last through the winter. And again, this is my personal theory. I'm not a doctor, but I read the medical literature as best as I can. I'm afraid it's going to become a social problem in the sense that even if the government does not mandate curfews or social distancing measures, you'll have a situation, say, in a food processing plant. Half the workers are sick, you'll have to shut down the facility. The news gets around. People like me will not go to shopping centers, cinemas, cultural events. They will shy public contact. What does that mean? Well, it means simply that economic activity will slow down and supply chains will break down once again simply because half the workers in X number of plants are sick. So it is an economic problem. It's also a health problem simply because even if Omicron is not very deadly, people who get sick don't think that way. If you have a headache, you're dying, you're going to run to the hospital. So the hospital system is going to be inundated. And a lot of people from suffering from other diseases will die. That's socially extremely unpleasant as well as economically depressing. You bring all of these factors together and we come to the biggest problem, unemployment. Turkish GDP recovered from the pandemic, but Turkish unemployment never did. There are several unemployment measures. I am using the broad-based unemployment. As of May, 22.5% of Turkish population able and willing to work either was unemployed or was working part-time. In the summer, it's going to get better. But what's going to happen in the winter? Well, let me give you a past example. In the previous peaks, that broad-based unemployment rose all the way to 28%. If we assume the same thing happens, we're going to get a 6 percentage point rise in unemployment. Once again, very bad for the government. But more importantly, imagine the situation of a population where 30% is either unemployment or is not working enough hours. Heat bills, electricity bills are going through the roof. Inflation is triple digits. You can't buy enough food or clothing for your children. It's going to get extremely unpleasant. This is why I think Turkey will not survive this winter. Now, let's name this baby. What do I mean? It will not survive. I mean, will we crash as a nation? Will we have a civil war? No. But several things are very likely to happen. The first is, of course, a balance of payments crisis, which means Turkey will default on its foreign loans. That's not very likely for the Turkish treasury, but several Turkish companies may. I think before we get to the point where the central bank runs out of FX reserves to pay Turkey's foreign liabilities, Turkey will impose official capital controls, which means that retailers, people, and corporates will not be able. I'm sorry, I'm hearing voices. Maybe I should get a PCR test. Let me repeat myself. Currency or capital controls means domestic depositors and companies will not be able to transact with their FX deposits in the banks. They will be effectively frozen to reduce the pressure on the exchange rate, and some of it will be transferred to the central bank to make foreign debt payments. That obviously is not very pleasant for the population. The second problem is you could have a massive economic crash, that's a deep recession, where because of currency instability, lack of confidence in the government, COVID, and three-digit inflation making production impossible. And Turkish activity will come to a standstill after three decent quarters, not strong growth, but moderate to middling. Turkey will have 2 or 3 quarters of negative growth, which will exacerbate the unemployment problem. And or we will have mass social unrest. I'm sure you have watched the scenes in Sri Lanka where the presidential palace was raided, but if you dig into the global news, you will see a lot of countries where there is a lot of uh, dismay with the economic conditions. Madagascar is going through famine. Sahel region, again, that sub-Saharan Africa is going through a food crisis. Latin America is not doing that well. Turkey will be in the same situation. In that situation, people riot. They write against whom? They write against the others. Who are the others? People who are not like us. People who we blame for all of our ills. In the United States, obviously, that's the migrants. In Turkey, too, we have 4 million Syrian migrants, roughly half a million Afghans, a lot of people who came from Africa to work in Turkey. They may be subjects of hate crimes. Turks may turn against each other, against the police, or against the government. All in all, we're facing a perfect storm. After a relatively calm summer season, all hell will break loose in the Turkish economy in the winter. And at the end, these type of events reformat the political system. Mr. Erdogan and his AKP MHP government will have to go either by snap elections or by elections on time, and they'll be replaced by a new leadership composed of opposition parties, which will try to do better for Turkey. My next video, by the way, is going to be about that opposition, and I'm going to ask the question: well, it's really messy in Turkish economics now. Can the opposition steer the economy in the right direction? If you're interested, subscribe, I suppose, or put a like. Uh, but most importantly, just keep watching me, even though audience is small. I like the comments. I like to get the word out about Turkey. This is Atilla Yeşilada presenting for Real Turkey channel. Stay chill.